Let me ask you something. If saving money made people rich, why are most people who save carefully still stressed about money? Here's the uncomfortable truth Jim Cramer opens this book with. Saving keeps you alive. Investing changes your life. Most people are taught one rule about money. Work hard, save your paycheck, don't take risks. Sounds responsible, right? But Cramer says that mindset is exactly why people fall behind. Because inflation doesn't care how disciplined you are. If your money just sits there, it's quietly losing power every single year. Imagine two people. Person A saves $500 a month for 20 years in a savings account. Person B invests $500 a month into strong companies and reinvests the gains. At the end of 20 years, Person A feels proud but disappointed. Person B, their money has been working while they were sleeping. Same effort, completely different outcomes. That's the power of investing. Cramer's core message here is simple but powerful. If you don't invest, you're choosing to fall behind. Not because you're lazy, not because you're bad with money, but because the system is designed to reward ownership, not just labor. Stocks represent ownership in real businesses. And over time, great businesses grow. This is the mental shift Cramer wants you to make early. Stop thinking like a saver. Start thinking like an owner. Owners benefit from growth. Owners benefit from innovation. Owners benefit from time. So here's the lesson you can apply today. Saving is defensive. Investing is offensive. Your goal isn't to avoid risk, it's to understand it. The earlier your money starts working, the harder it works. This book isn't about gambling. It's about learning how to put your money on your side. And in the next chapter, Jim Cramer goes straight at one of the biggest debates in investing. Are index funds enough, or are they holding you back? That's Chapter 2, the truth about index funds. Index funds are everywhere. If you've ever searched how to invest on Google, you've heard this advice. Just buy an index fund, set it and forget it. Jim Cramer doesn't say that advice is wrong, but he does say this. It's incomplete, because index funds are safe. But safe is not the same as smart for everyone. Here's the truth Cramer wants you to understand. When you buy an index fund, you're buying everything. The great companies, the average companies, and the bad ones. You're not choosing winners. You're accepting the average. And average is fine. If your goal is not to think. Now let's be clear. Index funds are an incredible starting point. They give you diversification. They protect you from making emotional mistakes. They're perfect if you don't want to research businesses. But here's where Cramer pushes back. If you do the work, if you actually learn how companies grow, index funds quietly cap your upside. Let's look at a real-world example. The S&P 500 is full of companies that barely grow at all. But it also includes Apple, Amazon, Nvidia, Microsoft. When those companies explode upward, their gains get diluted by hundreds of slower businesses. So while the index moves steadily, individual winners can change your financial future. This is the key distinction Cramer makes. Index funds protect you from being wrong. Individual stocks reward you for being right. And Wall Street rarely explains that difference. Cramer isn't saying, dump your index funds. What he is saying is this. If index funds are the foundation of your house, individual stocks are the rooms that create real value. You don't build wealth by avoiding decisions forever. You build it by learning to make better ones. Here's the mindset shift. When you only buy index funds, you're outsourcing thinking. When you buy individual stocks, you're taking responsibility. Responsibility means risk, but it also means control. So here's the practical takeaway you can use immediately. Index funds are great for protection. Stocks are great for opportunity. The real question isn't which is safer. It's how much effort am I willing to put in? Because effort is what creates edge. And this leads directly to the next chapter. If individual stocks can outperform, how do you actually find the great ones? That's exactly what Jim Cramer breaks down next, when he talks about the glory of individual stocks. Chapter 3, the glory of individual stocks. Let's talk about the part of investing that actually changes lives. Not index funds, not savings accounts, individual stocks. This is where real wealth is created, and also where most people get scared and walk away. Here's the uncomfortable reality. Almost every massive personal fortune built in the stock market came from owning a few great companies, not hundreds of average ones. And Jim Cramer says this very clearly. One great stock can outperform an entire portfolio. Think about companies like Apple, Amazon, Nvidia, or Microsoft. These weren't just stocks. They were businesses solving real problems, scaling globally, and compounding value year after year. If you owned them early and held them, they didn't just grow your money. They changed your financial trajectory. Now here's where people get it wrong. They hear individual stocks and immediately think gambling. Cramer flips that idea on its head. Buying random stocks based on hype is gambling. Buying a great business you understand is investing. The difference isn't risk. The difference is knowledge. When you own an individual stock, you're not betting on a chart. You're owning a business. You're asking questions like, does this company have pricing power? Is demand growing? Can competitors catch up? That's not speculation. That's ownership thinking. Here's the part Wall Street doesn't emphasize. Index funds smooth out volatility, but they also smooth out greatness. Individual stocks concentrate your results. That means bigger swings, yes, but it also means bigger rewards. When you're right, and Cramer's point is simple, if you never concentrate, you never outperform. This doesn't mean you go all in on one stock. It means you intentionally choose a small number of businesses you believe in deeply and are willing to hold through noise, because the biggest gains don't come from trading. They come from time. Here's the practical lesson you can use today. Stop asking, what stock will pop this week? Start asking, what company will be bigger in 5 years? Learn the business before you buy the ticker. That's how individual stocks go from scary to powerful. And this sets up the next critical question. If individual stocks are where the real opportunity is, how do you actually get an edge over everyone else? That's exactly what Jim Cramer tackles next when he talks about finding an edge. Chapter 4, Finding an Edge. If individual stocks are where real money is made, here's the obvious question. How do you beat everyone else? Jim Cramer's answer is simple and uncomfortable. You don't need insider information. You need an edge. Most people think Wall Street wins because they're smarter. They have better degrees, better connections, better data. Cramer says that's not the real advantage. The real advantage is this. Most people don't do the work. An edge is anything that helps you understand a business better or earlier than the crowd. It doesn't have to be fancy. In fact, the best edges are usually boring. Let's talk about a real-life example. Think about the products you use every day, where you shop, what apps you open, what services you can't live without. Regular people noticed Amazon was changing shopping long before Wall Street fully priced it in. Gamers saw Nvidia's chips dominate performance before it became an AI headline. That awareness, combined with research, is an edge. Here's the key point Cramer makes. Your edge often comes from your own life, your job, your habits, your curiosity. If you work in healthcare, you see trends early. If you work in tech, you feel demand shifts first. If you pay attention, you notice what's growing and what's quietly dying. Now, this is important. An edge is not a guarantee. It doesn't mean you'll always be right. It means you're making informed decisions instead of reacting to headlines. Most investors chase stories after prices move. People with an edge recognize the story before it becomes obvious. Cramer also warns about fake edges. Hot tips, social media hype, someone saying trust me. That's not an edge. That's noise. A real edge survives basic questions. Does this company make money? Is demand real? Is growth sustainable? If it falls apart under research, it was never an edge to begin with. Here's the practical takeaway you can apply right now. Pay attention to your daily life. Notice what's improving, scaling, or replacing old habits. Then confirm it with real research. Your edge isn't speed, it's understanding. And this leads directly to the next step. Once you believe you've found an edge, you still need a system, because ideas without structure turn into mistakes. That's why Jim Cramer moves next, into proving that investing really isn't that hard. Chapter 5, The Case of Nvidia. This is where theory turns into reality. Jim Cramer doesn't just talk about finding great stocks. He shows you what one actually looks like. And his favorite example, Nvidia. Years ago, NVIDIA was known as a gaming company. Graphics cards, PC enthusiasts, a niche business. Most investors stopped thinking right there. But Cramer didn't. Because when you looked closer, NVIDIA wasn't just selling chips. It was selling computing power. And demand for computing power never goes backward. Here's the key lesson. Great stocks often start as misunderstood stocks. Wall Street saw NVIDIA as cyclical. Gamers come and go. Hardware gets commoditized. But the business kept expanding quietly. From gaming to data centers to artificial intelligence. Same company, bigger vision. This is where having an edge matters. Engineers, gamers, and tech insiders knew NVIDIA's chips were years ahead of competitors. They saw the performance gap. They felt the demand. By the time AI became a headline, the stock had already done a lot of its work. Cramer's point is critical here. You don't need to predict the future perfectly. You need to recognize direction. NVIDIA wasn't a one-year story. It was a multi-decade trend. And the market always rewards companies that sit at the center of unstoppable forces. Now, let's talk about patience. Most people would have sold NVIDIA early, after a double, after a correction, after bad headlines. But big winners don't feel comfortable. They test your conviction. They make you question yourself. They shake out weak hands. Cramer emphasizes this. The hardest part isn't buying great stocks. It's holding them. This is why research matters. If you understand why a company is winning, short-term volatility doesn't scare you. Price drops feel temporary. The business story stays intact. That's how long-term gains are built. Here's the practical takeaway you can apply today. Look for companies enabling massive trends, not chasing them. Ask what problem they solve better than anyone else. Then ask if that problem will matter more in the future than today. That's how NVIDIA went from just a gaming stock to one of the most important companies in the world. And this brings us to an important realization. If you know what to look for, if you focus on businesses, not noise, investing isn't as complicated as Wall Street wants you to believe. That's exactly where Jim Cramer goes next. Chapter 6. It's not that hard. After seeing a stock like NVIDIA, most people think the same thing. Yeah, but I could never do that. Jim Cramer calls that belief out immediately. Because investing looks complicated, but it doesn't have to be. And Wall Street benefits from making you think it is. Here's the illusion. They surround investing with jargon, complex models, endless opinions. And the result? People freeze. They assume if they don't understand everything, they shouldn't do anything. Cramer says that mindset is the real danger. Let's be honest. You don't need to predict interest rates. You don't need to time the market perfectly. You don't need a finance degree. What you need is a repeatable process. Most successful investors aren't geniuses. They're consistent. Think about how you make everyday decisions. You don't need perfect information. To choose a good restaurant, you look at quality, reputation, demand. Investing works the same way. Is the business growing? Is the product in demand? Does the company execute well? If you can answer those questions, you're already ahead of most people. Cramer makes this point very clear. People lose money not because investing is hard, but because they make it emotional. They chase what's hot. They panic on drops. They overreact to headlines. Complexity isn't the enemy. Emotion is. This is why simplicity wins. A simple thesis. A clear reason for buying. A long-term time horizon. When the market pulls back, and it always does, simple investors stay calm. Because they know what they own, and why they own it. Here's another hard truth. Doing nothing feels safe. But over time, it's the riskiest choice of all. Inflation compounds, opportunities pass, and regret quietly builds. Cramer's message here is empowering. You don't need to be perfect. You just need to start and stick to a process. So here's the practical takeaway you can use today. Stop waiting to feel ready. Focus on understanding a few great businesses. Keep your strategy simple enough to follow in bad markets. Investing isn't easy, but it's not complicated either. And once you accept that, you're ready for the next step. Because simplicity still needs structure. That's why Jim Cramer moves next, into laying out a plan that works in any market. Chapter 7. The Make Money in Any Market Plan. Once you accept that investing isn't that hard, the next question becomes obvious. What's the plan? Because confidence without structure is how people lose money. Jim Cramer's answer is straightforward. You need a plan that works in any market, bull, bear, or somewhere in between. Most investors only know how to invest in good times. When stocks are going up, everything feels easy. Risk feels invisible. Mistakes get rewarded. But markets don't stay friendly forever. And when conditions change, people without a plan panic. Cramer's strategy starts with one rule. You don't invest the same way. In every market environment, different markets reward different behaviors. Strong economies favor growth. Uncertain times favor stability. High rates change what's attractive. The plan adapts, not emotionally, but intentionally. Here's what that actually looks like. In strong markets, you lean into high-quality growth companies, businesses with expanding demand, pricing power, and long runways. In tougher markets, you shift toward companies that make money now. Cash flow, dividends, resilient demand, same discipline, different emphasis. The mistake most people make is going all in on one style. They only buy aggressive growth until it stops working, or they hide in safety forever and miss opportunity. Cramer's plan avoids extremes. It balances offense and defense. Another critical piece of this plan is flexibility. Not trading every headline, not guessing bottoms, but being willing to adjust when the facts change. A company that stops executing doesn't deserve blind loyalty. A new opportunity deserves attention. This isn't stubborn investing. It's adaptive investing. Cramer also emphasizes position sizing. You don't bet your future on one idea. Even great ideas can be early. A plan protects you from being right at the wrong time. That's how you stay in the game long enough for compounding to work. Here's the practical takeaway you can apply today. Build a portfolio that can survive bad markets. Lean into opportunity when conditions improve. Let facts, not fear, guide adjustments. The goal isn't to predict the market. It's to be prepared for it. Because once you have a plan, the next challenge becomes focus. There are thousands of stocks, too many choices. That's why Jim Cramer moves next into narrowing the field of options. Chapter 8, Narrowing the Field of Options. Once you have a plan, you hit a new problem. There are too many stocks, thousands of tickers, endless opinions, constant noise. Jim Cramer says this clearly. Too many choices is a disadvantage, not an advantage. Most investors don't lose money because they pick the wrong stock. They lose money because they never narrow the field. They jump from idea to idea. They chase whatever sounds exciting today, and they never build conviction. Cramer's approach starts with elimination. Not asking, what should I buy? But asking, what can I ignore? That mindset alone puts you ahead. The first filter is simple. If you don't understand the business, it's out. No matter how popular the stock is, no matter who's talking about it. If you can't explain how a company makes money in 1 or 2 sentences, you don't own it. The second filter is quality. Is revenue growing? Is the balance sheet solid? Does the company consistently execute? Most stocks fail right here. And that's good, because every stock you eliminate gives more clarity to the ones that remain. Then comes the most overlooked filter. Is there a reason to own this stock now? Not someday. Not it might bounce. Now. Is there a catalyst? A trend? A clear path forward? Good companies without momentum can stay dead money for years. Cramer wants focus, not hope. Here's what this process actually looks like in real life. You start with hundreds of stocks. You narrow to sectors you believe in, then to companies you understand, then to the few with real upside right now. At the end, you don't have dozens of ideas. You have a watch list, and that watch list is your edge. This step is where discipline matters most, because boredom feels uncomfortable. People want action. They want to feel busy. But Cramer reminds you, waiting is a position. Cash is a decision. Not every day is a buying day. Here's the practical takeaway you can apply today. Eliminate more than you select. Only follow businesses you truly understand. Build a focused watch list, not a scattered portfolio. Clarity creates confidence. Confidence creates patience. And once you've narrowed the field, The next question becomes unavoidable. If you have to grade stocks, which one is actually better? That's exactly where Jim Cramer goes next, when he talks about comparing one stock to another. Chapter 9, Comparing one stock to another. Once you've narrowed your watch list, you face a smarter problem. You don't have bad stocks anymore. You have good ones. So now the question changes. Not is this a good company, but is this the best use of my money right now? Jim Cramer is very clear about this. You should never evaluate a stock in isolation, because money is limited and opportunity cost is real. Every dollar you invest somewhere is a dollar you don't invest somewhere else. Most investors skip this step. They fall in love with a story. They buy the stock and they stop thinking. Cramer says that's a mistake. Good investing is comparative. Here's how this works in real life. Let's say you're looking at two companies in the same industry. Both are profitable. Both are well known. Both seem safe. Now you compare. Which one is growing revenue faster? Which one has better margins? Which one has stronger demand trends? The better stock isn't the one you like more. It's the one that executes better. Cramer pushes this idea hard. Stocks don't go up because they're famous. They go up because they outperform expectations. When you compare stocks side by side, weakness becomes obvious. One company is innovating. The other is defending. One is expanding margins. The other is stuck. The market notices, eventually. Another key comparison is valuation. A great company can still be a bad investment if the price already assumes perfection. So Cramer asks a simple question. Which stock offers more upside? From today's price? Not from last year. Not from the bottom. From now. This is where discipline protects you. Instead of chasing what already ran, you choose what's positioned to run next. Comparison keeps you rational when emotions try to take over. Here's the mindset shift. You're not choosing stocks. You're choosing opportunities. And opportunities only make sense relative to alternatives. That's how professionals think. That's how capital is allocated. Here's the practical takeaway you can apply today. Always compare stocks within the same space. Ask which company is executing better right now. Let performance, not popularity, guide your choice. Comparison turns good ideas into better decisions. And once you've chosen the stronger stock, there's still one critical question left. Is it worth the price you're paying? That's exactly where Jim Cramer goes next, when he breaks down how to figure out what a stock is actually worth. Chapter 10, Figuring out what a stock is worth. At this point, you've done a lot right. You found good companies. You compared them. You picked the stronger one. But now comes the question that separates investors from gamblers. Is this stock actually worth the price? Jim Cramer repeats this idea over and over. A great company can still be a terrible investment if you overpay for it. And a boring company can be a great investment if the price is right. Price matters. Most beginners look at a stock price and think it's expensive or cheap based on how high the number looks. Cramer says that's the wrong way to think. A $20 stock can be expensive. A $500 stock can be cheap. What matters is value, not the sticker price. So how do you think about value without turning investing into math homework? Cramer keeps it practical. You start with growth. Is the company growing revenue? Is earnings expanding? Is demand increasing year after year? A growing business deserves a higher valuation than a stagnant one. That's common sense. Next, you look at expectations. What does the market already believe? If a stock is priced for perfection, everything has to go right just to break even. But if expectations are low and the company is executing well, there's room for upside. That gap between reality and expectations is where money is made. Cramer also emphasizes comparison again. You don't value a stock in a vacuum. You compare it to peers. If two companies grow at similar rates, but one is priced much higher, you ask why. Sometimes the premium is justified. Sometimes it's hype. Your job is to tell the difference. Here's another important idea. Valuation is not about being precise. It's about being reasonable. You're not trying to find the perfect price. You're trying to avoid paying an unreasonable one. That mindset alone saves investors from huge mistakes. This is where patience comes back into play. You don't have to buy immediately. Great companies give you multiple chances. Market pullbacks happen. Sentiment shifts. Waiting for a better price is part of the process. Here's the practical takeaway you can apply today. Don't confuse a great company with a great deal. Ask what growth the current price already assumes. Look for a margin of safety, not perfection. Value protects you when the market gets emotional. And once you understand value, the next mystery becomes easier to solve. If valuation makes sense, what actually causes a stock to move up? That's exactly where Jim Cramer goes next, when he breaks down what really makes stocks rise. Chapter 11. So what makes a stock go up? Once you understand value, the next question is unavoidable. What actually makes a stock go up? Not hope, not hype, not because you believe in it. Jim Cramer is blunt here. Stocks move for reasons. Most people think stocks go up because the economy is strong or because the market is bullish. That's not wrong, but it's not specific enough to make money. Cramer wants you to think smaller and sharper. Stocks go up when reality beats expectations. Every stock has a story baked into its price. How fast it's supposed to grow, how profitable it's supposed to be, how strong demand is expected to remain. When a company performs better than that story, the stock moves higher. When it disappoints, the stock gets punished, even if the business is still good. This is why earnings matter so much. Quarterly reports are not just numbers, they're scorecards. Did revenue grow faster than expected? Did margins improve? Did management raise guidance? Those are the moments when stocks reprice, not slowly, quickly. Cramer emphasizes guidance even more than earnings because the market is forward-looking. A company can beat this quarter and still sell off if management sounds cautious about the future. Words move markets when expectations are fragile. Here's a key insight. Stocks don't move based on absolute performance. They move based on relative performance. A company can grow 20% and still drop if the market expected 25%. Another company can grow 5% and rally if expectations were near zero. Understanding that changes how you invest. This is why valuation from Chapter 10 matters so much. If expectations are already sky high, there's no room for upside. But when a solid company quietly improves and expectations lag behind reality, that's when big moves happen. Cramer also warns against one common mistake: falling in love with a stock and ignoring new information. The market is constantly updating its beliefs. So should you. Being flexible doesn't mean being weak. It means being rational. Here's the practical takeaway you can apply today. Stocks rise when results beat expectations. Focus on earnings, guidance, and demand trends. Always ask, what does the market already believe? If you know the expectations, you can understand the reaction. And once you understand why stocks move, the next challenge becomes personal. How do you consistently choose the right ones? That's exactly where Jim Cramer goes next, when he talks about choosing well. Chapter 12, Choosing Well. At this stage, you already know a lot. You understand value. You know what makes stocks move. You know expectations matter. So now the real question becomes, why do smart people still make bad choices? Jim Cramer's answer is simple. Because choosing well is not about intelligence. It's about discipline. Most investing mistakes don't happen because people lack information. They happen because people ignore their own rules. They chase what's exciting. They rush decisions. They confuse confidence with certainty. Cramer says choosing well means slowing down, especially when emotions speed up. Here's the framework he pushes. Before you buy a stock, you should be able to answer 3 questions clearly. Why this company? Why now? And what would make me admit I'm wrong? If you can't answer all 3, you're not investing. You're hoping. Choosing well also means knowing your limits. You don't need to own every great stock. You don't need to catch every rally. Missing opportunities is part of long-term success. Trying to catch everything is how portfolios get messy. Cramer emphasizes conviction, but not stubbornness. When the facts support you, you stay patient. When the facts change, you change with them. Good investors don't marry stocks. They partner with them, as long as the relationship makes sense. Another key idea here is consistency. Great investors don't change strategies every month. They use the same process in good markets and bad ones. That consistency builds confidence, and confidence keeps emotions in check. When volatility hits, Cramer also warns about overconfidence. Just because a stock worked once doesn't mean it always will. Markets evolve, businesses change, competition adapts. Choosing well means staying humble, even when you're right. Here's the practical takeaway you can apply today. Write down your reasons before buying any stock. Decide in advance what would make you sell. Follow a repeatable process, not feelings. Good investing isn't flashy, it's deliberate. And once you learn how to choose well, the next skill becomes essential, because good choices still need good information. That's why Jim Cramer moves next into how to research stocks properly. Chapter 13, How to Research Stocks. At this point, one thing should be clear. Good investing doesn't come from tips. It comes from research. And Jim Cramer is very direct about this. Research is your unfair advantage. Most people think research means spreadsheets, complex models, and hours of math. Cramer says that's not what matters most. Great research starts with one simple goal: understanding the business. If you don't understand how a company makes money, everything else is noise. So where do you start? You start with the basics. What does the company sell? Who are its customers? Why do people choose it over competitors? If you can't answer those questions clearly, you're not ready to invest. Cramer emphasizes reading what the company writes about itself, annual reports, earnings summaries, investor presentations, not to memorize numbers, but to understand the story management is telling. Because every company is pitching you something. Your job is to decide whether that story matches reality. Next, you look for confirmation. Is revenue actually growing? Are margins improving? Is demand expanding or slowing down? This is where numbers support the story or expose weaknesses. You don't need advanced formulas. You need consistency. Are results getting better over time? Another critical part of research is understanding competition. No company operates alone. Who are their biggest rivals? What makes this company different? Is that advantage sustainable? If competitors can easily copy the product, the edge won't last. Cramer wants you to think long-term here. Research also means following the business over time, not just before you buy, but after. Do they hit their targets? Do they explain setbacks honestly? Do they adapt when conditions change? Trust is built quarter by quarter. Here's where most people stop too early. They read headlines. They skim summaries. They assume they've done enough. Cramer says real research creates conviction, and conviction is what keeps you calm when the stock drops, but the business is still strong. Here's the practical takeaway you can apply today. Research the business, not just the stock price. Let numbers confirm or challenge the story. Follow companies over time, not just at purchase. Research doesn't guarantee you'll be right, but it dramatically lowers the odds of being wrong for the wrong reasons. And once you understand how to research, the next step is learning to read the language companies speak best, because balance sheets and income statements tell you what words never will. That's where Jim Cramer goes next. Chapter 14, Reading Financial Statements Like a Pro. For a lot of people, this is where investing starts to feel intimidating. Balance sheets, income statements, cash flow. Jim Cramer understands that fear, and he cuts through it fast. You don't need to be an accountant. You just need to know what to look for. Let's start with the most important idea. Financial statements are not there to impress you. They're there to tell you how healthy the business really is. And the numbers never lie, even when the story sounds great. Cramer begins with the income statement. This is where you see if a company is actually growing, revenue up or down, margins expanding or shrinking, earnings improving over time. You're not looking for perfection. You're looking for direction. Is the business getting stronger or weaker? Next is the balance sheet. This is where you see how stable the company really is. How much debt does it have? How much cash is available? Can it survive a downturn? A fast-growing company with too much debt is fragile. Cramer wants businesses that can stay standing when conditions get tough. Then comes the most overlooked statement: cash flow. Because profits can be manipulated, but cash is real. Is the company actually generating cash? Or is it constantly raising money to survive? Strong businesses fund their own growth. Weak ones rely on hope. Here's the key mindset Cramer teaches. Don't get lost in the details. You're not trying to catch fraud. You're trying to spot patterns. Consistent revenue growth, improving margins, healthy cash flow. When those line up, the business usually follows. Cramer also emphasizes comparison again. Numbers only make sense in context. Is this company improving faster than competitors? Is it strengthening while others struggle? That's how financials become powerful. Most people avoid this step because they're afraid of getting it wrong. Cramer says that fear is misplaced. You don't need to be perfect. You just need to avoid obvious weakness. Financial statements help you do exactly that. Here's the practical takeaway you can apply today. Focus on trends, not single quarters. Look for strong cash flow and manageable debt. Use financials to confirm or challenge the story. When the numbers and the story agree, you're usually on solid ground. And once you understand the numbers, the next level is listening, because how management talks about the business often matters as much as the results themselves. That's exactly where Jim Cramer goes next, when he breaks down the conference call. Chapter 15, the conference call. At this stage, you know the numbers. You've seen the revenue, the margins, the cash flow. But Jim Cramer says something important here. Numbers tell you what happened. Conference calls tell you what's coming next. Most investors ignore earnings calls. They glance at headlines. They look at the stock's reaction, and they move on. Cramer says that's a mistake, because earnings calls are where management reveals how confident they really are. Here's what you need to understand. Every CEO knows investors are listening. Every word is chosen carefully. So your job isn't just to hear what they say. It's to listen for how they say it. Confidence matters. Clarity matters. Consistency matters. Strong management sounds prepared. They explain results clearly. They acknowledge challenges directly. They give guidance without dodging. Weak management sounds defensive. They blame the macro environment. They avoid direct answers. They talk a lot, but say very little. That difference shows up long before the stock moves. Cramer pays special attention to the Q&A section, because that's where things get real. Analysts ask tough questions. Management can't hide behind slides. Do they answer directly? Do they get uncomfortable? Do answers change quarter to quarter? Those signals matter more than most investors realize. Another key insight here. Listen for changes in tone. A company that suddenly becomes cautious after months of confidence is telling you something. The numbers might still look fine, but expectations are shifting. And remember from Chapter 11, stocks move on expectations. Cramer also warns against blind trust. Charismatic CEOs can sound convincing. Smooth language doesn't guarantee results. That's why conference calls must be paired with financial statements. Words without execution are meaningless. Here's how this fits into your process. You don't need to listen to every call live. You can read transcripts. You can focus on companies you already own or are seriously considering. The goal isn't speed, it's understanding. Here's the practical takeaway you can apply today. Listen for confidence, clarity, and consistency. Pay attention to tone changes, not just headlines. Use conference calls to judge management quality. Great companies usually have great communicators at the top. And once you understand management, the next step is zooming out, because individual stocks don't exist in isolation. They live inside industries. That's why Jim Cramer moves next into identifying winning sectors. Chapter 1-6-10 Winning Sectors. By now, you're thinking like an investor. You analyze companies. You study management. You understand numbers. Now Jim Cramer asks you to zoom out, because no stock exists alone. Every stock lives inside a sector. Here's the mistake most investors make. They fall in love with a company and ignore what's happening around it. But Cramer is clear. Money moves in waves, and those waves are called sectors. Sectors rotate. Technology leads for a while, then healthcare, then energy, then financials. Not because companies suddenly change, but because conditions change, interest rates, economic cycles, consumer behavior, capital flows where it's treated best. Cramer's advantage comes from recognizing which sectors are being rewarded right now, not guessing, not predicting years ahead, observing. Where are earnings accelerating? Where are analysts raising expectations? Where is demand clearly growing? That's where money flows first. This is why sector awareness matters. A great company in a weak sector can struggle for years. An average company in a strong sector can outperform expectations. Context matters more than people admit. Cramer encourages investors to build sector literacy. You don't need to master all 10 sectors. You need to understand which ones are winning and why. Ask simple questions. Is this sector benefiting from long-term trends? Is regulation helping or hurting? Is demand cyclical or structural? Those answers guide capital. Another key idea here is balance. You don't bet everything on one sector. Even winning sectors cool off. Diversification across sectors protects you from being right at the wrong time. Smart investors rotate. They don't cling. Cramer also warns against chasing late-stage trends. When everyone agrees a sector is unstoppable, most of the gains are already gone. The real opportunity comes earlier, when growth is visible, but belief isn't universal yet. That's where upside lives. Here's the practical takeaway you can apply today. Know which sectors are leading and which are lagging. Favor companies in sectors with strong tailwinds. Be willing to rotate when leadership changes. You don't fight the tide, you ride it. And once you understand winning sectors, the next step is seeing what winning actually looks like. Because great stocks leave patterns. That's why Jim Cramer moves next into studying recent great performers. Chapter 1:7 Recent Greats. If you want to understand what winning looks like, don't guess. Study the winners. Jim Cramer believes great stocks leave clues, and those clues repeat over and over again. Most people look at winning stocks and say, I missed it. Cramer looks at them and asks, why did this work? Because the goal isn't regret, it's pattern recognition. Think about some of the biggest winners of the past decade. Apple, Microsoft, Amazon, Nvidia. Different industries, different stories, but similar characteristics. They all had strong demand trends. They all dominated their niches. And most importantly, they kept beating expectations. Not once, not twice, consistently. That's how great stocks separate themselves. Another pattern Cramer highlights is reinvestment. Great companies don't just make money. They reinvest it intelligently into innovation, into scale, into competitive advantage. That reinvestment fuels the next leg of growth, and the market rewards that cycle. Winning stocks also survive skepticism. Early on, they're questioned, they're doubted, they're called too expensive. But quarter after quarter, the results silence critics. That persistence matters. Cramer also points out something important. Most great stocks don't explode overnight. They grind higher. They pull back. They consolidate. They frustrate impatient investors. And then, they continue higher. Time is the secret ingredient. This is why chasing what already spiked rarely works. By the time everyone agrees a stock is great, the easy money is gone. But studying past winners helps you spot future ones earlier. Here's the practical takeaway you can apply today. Study past winning stocks and identify common traits. Look for companies that repeatedly beat expectations. Favor businesses that reinvest to stay ahead. Winners leave footprints. Your job is to recognize them before the crowd does. And once you understand how growth stocks win, the next question becomes obvious. What if you want growth and income at the same time? That's exactly where Jim Cramer goes next, when he breaks down income-producing stocks with growth. Chapter 18, Income Producers with Growth. Up to this point, we've talked a lot about growth, fast-growing companies, big winners, long-term upside. But Jim Cramer knows, not every investor wants to wait years just to see results. So he asks a different question. What if you could get paid while you wait? That's where income-producing stocks come in. Dividends. Most people hear that word and think boring, slow, old companies. Cramer says that's outdated thinking, Because some of the best stocks do both. They pay income, and they grow. Here's why this matters. Income changes how you experience volatility. When a stock pays you regularly, price drops feel different. You're not just watching a number move. You're getting cash. That income gives you patience, and patience is a massive edge. Cramer focuses on a specific type of company. Businesses with steady cash flow, strong balance sheets, and the ability to raise dividends over time. Not high-yield traps, not desperate payouts, sustainable income. Think about companies that dominate essential services, utilities, healthcare leaders, consumer staples, select industrials. Demand doesn't disappear overnight. That stability allows these companies to reward shareholders without sacrificing growth. Another key point Cramer makes is reinvestment. When dividends are reinvested, they quietly compound. You're buying more shares without adding new money. Over time, that snowball effect becomes powerful, especially in choppy markets. Cramer also highlights timing. Income stocks tend to shine when growth stocks struggle. Rising rates, economic uncertainty, market pullbacks, money rotates toward reliability. Investors who ignore income completely miss this entire phase of the cycle. But here's the warning. Chasing the highest yield is a mistake. If a dividend looks too good to be true, it probably is. Cuts destroy trust and stocks. Cramer wants quality first, yield second. Here's the practical takeaway you can apply today. Look for companies that grow cash flow and pay dividends. Favor sustainable payouts over flashy yields. Use income to stay patient during volatility. Getting paid to wait changes everything. And once you understand income and growth together, the next question becomes unavoidable. What about the biggest stocks in the world right now? Are they still worth owning? Or are their best days behind them? That's exactly where Jim Cramer goes next, when he looks at the future of the Magnificent Seven. Chapter 19, The Future of the Magnificent Seven. At some point, every investor asks the same question. These stocks are already huge. Is it too late? Jim Cramer doesn't dodge this question. He goes straight at it, because the Magnificent Seven dominate headlines, portfolios, and market returns. Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, Tesla. Here's the first thing Cramer makes clear. Big does not mean done. Size alone doesn't stop growth. Lack of innovation does. And these companies didn't get big by accident. They earned their dominance. What separates the Magnificent Seven from past market leaders is adaptability. They don't just defend old businesses. They reinvent them. Apple built an ecosystem. Microsoft pivoted to cloud. Amazon turned logistics into a weapon. Nvidia positioned itself at the center of AI. These aren't static companies. They're platforms. Cramer's key insight is this. The question isn't, can they double again? The question is, can they keep surprising expectations? Because from Chapter 11, you already know how stocks move. As long as these companies continue to outperform what the market expects, they remain relevant investments. But Cramer also adds a warning. Not all of the Magnificent Seven will lead at the same time. Leadership rotates, even within greatness. Some will pause, some will stumble, others will surge ahead. Blindly owning them all, without analysis, is lazy investing. Valuation matters more here than anywhere else. When expectations are sky high, execution has to be nearly perfect. That doesn't mean you avoid these stocks. It means you size positions carefully and stay alert. Great companies can still be overowned. Another important idea Cramer stresses is time horizon. These stocks are not trades. They're long-term businesses. Short-term volatility is normal. Narratives change quickly, but durable advantages, data, ecosystems, scale, don't disappear overnight. That's where long-term investors win. Cramer also reminds you of concentration risk. The Magnificent Seven carry enormous weight in major indexes. If you own them, you should know why. Not because everyone else does, but because you understand their business models and future drivers. Here's the practical takeaway you can apply today. Don't fear size, fear stagnation. Own big stocks for their businesses, not their fame. Reevaluate leaders as expectations change. Great companies stay great by evolving. And now we reach the final chapter, because no investing journey is complete without mistakes, losses, regret, hard lessons. Jim Cramer ends the book by doing something rare on Wall Street. He admits his own. Chapter 20, Mistakes. I've made a few. Jim Cramer doesn't end this book with predictions. He ends it with something far more valuable. Mistakes. Because if you invest long enough, you will be wrong. Not once, not twice, but many times. And that's normal. Here's the truth most finance channels won't tell you. Great investors aren't the ones who avoid mistakes. They're the ones who survive them. Cramer openly admits some of his biggest losses came from ignoring his own rules, getting emotional, getting overconfident, holding too long or selling too early. Sound familiar? One of the biggest mistakes he highlights is falling in love with a stock. When a company becomes part of your identity, you stop listening. Bad news feels personal. Warning signs get rationalized. And by the time reality forces your hand, the damage is already done. Cramer's lesson is simple. Stocks don't care about your feelings. Another mistake, thinking you need to always be right. You don't. You just need your winners to matter more than your losers. That's why position sizing exists. That's why discipline matters. Losses are tuition. Only repeated losses are failure. Cramer also talks about timing. Being right too early feels exactly like being wrong. That's why patience and flexibility have to coexist. If your thesis is intact, volatility is noise. If the thesis breaks, ego has to step aside. Here's the most important takeaway from this final chapter. Mistakes don't disqualify you from investing. They're part of it. What ruins investors is refusing to learn from them. Every loss is data. Every bad trade is feedback. The market is a brutal teacher, but a fair one. Now let's zoom out. Over this series, you've learned how Jim Cramer thinks about money. You learned why investing matters, why index funds are a foundation, not a ceiling, why individual stocks create real wealth, how to find an edge, how to value businesses, how stocks actually move, how to research, choose, and manage risk, and most importantly, how to stay in the game. This was never about getting rich fast. It was about thinking clearly. In a world that profits from confusion, if you remember one thing from this entire series, remember this. Investing is not about being perfect. It's about being prepared and staying disciplined when emotions run high. Money rewards patience, markets reward ownership, and time rewards those who keep learning. If this series helped you think differently about investing, do 3 things for me. Hit the like button. It helps this channel reach more investors. Subscribe if you want clear, no hype breakdowns of money and markets. Comment below. What was the biggest lesson you're taking away from this series? And if you want the next series, let me know which book we should break down next. Because understanding money